Many thanks for joining us, Mr. Mehta and Mr. Bhargava. More recently, there have been a few concerns in the investor community as regards the growth plans and operations of Deepak Fertilizers and SmartChem. We would like to hear from you deeper perspectives as regards those concerns to better appreciate the scenario. To begin with, Mr. Mehta, can you please elaborate on the rationale for the sizable capex growth plan announced last year?
Sure. So let me take you a little bit back in the past and how we have evolved over the last 10 years, which will give you a feel of how the strategic transformation has played out. Some 10 years back, when we looked at ourselves, we saw we were more inward looking, focused on the integrated manufacturing activities. And when we examined ourselves from the outside in, we saw that we were serving three different sectors. One is the fertilizer sector, focus on the farmers. The second is pharma chemicals, where the focus was on fine chemicals and chemicals that served the pharmaceutical sector. And the third was mining chemicals, where we were serving whether it's coal mining, limestone, cement, or even in terms of the infrastructure, road making and others. Now that focus that we brought in, we translated that into an organization structure which moved from a conventional functional structure to an SBU focused structure. And over the decade and a half, it has certainly helped, because today as we see ourselves, in every single product that we manufacture, we are market leaders and we have market shares anywhere from 30-35% to 80%. The second thing that has happened is that our basket of products have a very interesting complementary nature, which brings a risk mitigation within the basket, meaning that if the fertilizer sector is prospering because of post rains, the season is good, and mining is little low, post that mining picks up when the fertilizer season is over. So there is a risk mitigation that happened naturally into the three different baskets. The third aspect that we saw was that each of our products were very sharply aligned with the country's growth story, and there is a lot of wind behind the sail that has emerged thanks to the alignment that we are seeing, and that has happened over these years. To elaborate, if India has to grow, it needs power, and for that it needs coal. Any coal mining would require our TAN product. If India has to grow, similarly it needs cement, and to get limestone, there is no other way but to utilize TAN. Or if Mr. Nitin Gadkari's dreams have to come alive for roads, highways and the like, again it will happen only with TAN. Similarly, as we know that India has now found its place in the global map as a supplier of pharmaceutical products, and the health sector is anyway a recession proof industry. So every pharmaceutical would need our IPA as a solvent, as a base. When it comes to the fertilizer sector also, as we know that as India grows and the middle income group grows, the need for fruits, vegetables is going to be something that is always going to be growing. All the three sectors align with the country's growth story. Now, when we started looking at ourselves some 3 years back, we said, where do we go from here? And we've drawn in inputs from various management consultants and a lot of internal deliberation. And we saw that there are two aspects which would give us then a profitable next 10 years, 15 years, 20 years. The two-pronged strategy that we have put in place, one is get our size right. Why is that? Getting the size right gives us huge economies of scale. It could be also something where we could get advantageous raw material purchasing powers. We could get advantages in terms of managing the manufacturing, dealer network, logistics. So, a lot of cost advantages would emerge out of the right size. So, one was to get a size right. The second is to do backward integration, so that within our value chain we capture from raw material to finished product. One, it can help us capture the vagaries of the two sides, upstream and downstream. Second is it can bring a lot of risk mitigation, because the downstreams get the support of the upstream. What we have done is, the above strategies have been very strongly then and in a dedicated manner implemented. So, few years back we took up with 800 crore investments, tripling of our NPK capacities. Now, NPK fertilizer vis-a-vis the other options that we had in terms of either urea or DAP or others, NPK gives us the opportunity of making various crop specific grades in the same plant. Second is, we are sitting in virtually the horticulture capital of the country. Maharashtra, Gujarat, Karnataka are indeed focused on the high value fruits and vegetables, and the demand is of a kind where we would find an easy replacement of the imported fertilizers by our manufactured product. So, that investment we had taken up, and a year and a half back it is already commissioned and we are in a stabilization phase. Our capacities are now enhanced from the 2.5 lakh that was there prior to this expansion. We are today 8 lakhs, and very shortly with minor tweaking, minor marginal investments, we would be crossing 1.1 million. With this, our market share has jumped from some 3% odd to almost 22-23%. The second expansion that we took up was with a 550 crore investment, adding a complete nitric acid complex at Dahej, which is closer to the marketplace. So, we expect to commission our Dahej nitric acid complex shortly, and it will be within the before the end of the financial year. With this nitric acid complex, we will become Asia's largest acid complex and providing a whole range of nitric acids to the industry, right from 58%, 60%, 62%, right up to 98%. The third project that we have envisaged, which is what we are going to see in the next 24 to 30 months, is with a 1500 crore investment. We are looking at adding one more TAN complex, and as I shared that with the growth in the mining sector that we see, this is something is a very positive traction that we are noticing. With that, from being the 5th largest in the world today, we will climb up to becoming among the world's top 3 as far as TAN goes. With an investment of around 770 crores, we are planning to also add to the IPA capacities, and there the 80% market share that we have today, but some chunk of it is being serviced by the imported product. Post this expansion, we will be able to service it with our own manufactured product. The raw material which is in short supply, propylene, is something that we have already tied up. Now, this first leg of our strategy, get your size right, we are looking at now its conclusion in terms of tripling of our fertilizer capacities, Asia's largest acid complex. Both of these are virtually behind us, and in case of TAN, we will become among the top 3, and as far as IPA goes, we will continue to look at a dominant market share. That is the first leg of our strategy. The second one, backward integration into the value chain. So, there we saw that for our downstream needs, we were looking at importing almost 500,000 tons of ammonia as we go forward. And ammonia, as we know, is a lifeline for all the three businesses: fertilizers, pharma chemicals and TAN. So, keeping that need in mind, we are looking at an expansion into a ammonia facility with a 3,000 crore investment, where we would be looking at adding 500,000 tons, 100% to be utilized for our ready downstream. What we saw there was that if we would have continued the imports, we could be looking at almost $60 to $70 of costs of freight from the Middle East to India, all the vagaries of port congestion at JNPT to importing it tanker by tanker to our Taloja site. Now, not only to save that kind of a freight cost, but also the vagaries of the tanker movement, we had thought of this ammonia project to make sure that we are also environmentally sustainable in terms of these operations. And we are looking at this project just across our current complex, and so the ammonia will be just piped 1 kilometer straight into the downstream. This is also going to be, in one sense, risk mitigated because of the ammonia supply is going to 3 different sectors, and it will help serve in terms of the total downstream complex. So, this is broadly the growth plan.
Mr. Amitabh, what are our funding plans for the projects? Also tell us what all funding has been tied up and our time plan for the rest.
We completed the NPK capex cycle last year, and nearly 1/3 of that debt we have already repaid. As far as the Dahej project is concerned, we expect that project would complete before this financial year and would start generating the cash. The repayment of the debt for the Dahej project would start only after 1.5 years of moratorium. As far as the 3 new projects are concerned, ammonia project, which is about 3,000 crore of investment, we have already financially closed this project. So about 2,050 odd crores of debt has been completely underwritten by banks. This is it's at very attractive terms, where the repayment of this starts only after 1.5 years of completion of the project, and door to door 19 years of maturity. The other 2 projects, TAN and IPA, the debt funding is in a fairly advanced stage of discussion with banks, and given our AA- rating on long term and the strong fundamental of these projects, we are confident that the financial closure of these 2 projects would also be done very soon. As far as the equity is concerned, we are looking at nearly about 1,500 crores of equity raising plan that we have, and we have a 3-pronged approach for that. 200 crores of equity will come through promoters subscribing. Earlier promoters had brought in 25% of advance as far as the promoter warrants are concerned. The balance 150 crores would also be brought in due course. We are at a fairly advanced stage of discussion with 2 large multilateral institutions who are going to bring in equity and equity linked investments in SmartChem as well as in Deepak Fertilizer. They've completed almost 1 full year of detailed due diligence exercise, and their investment approvals are at the last stages. So we expect that the contracts for those would be signed fairly soon. As far as the balance, about 600 odd crore is concerned, we had earlier taken shareholders approval for a QIP and other equity and equity linked instruments. Of course, the timing of that would be subject to market conditions. We expect that over next 6 to 12 months, depending on market conditions, we would be in a position to raise this amount through more than 1 tranches maybe. So that's the broad funding plan for these projects.
Mr. Mehta, we understand the company has basket of urban and industrial land parcels. What could be its approximate value? Are there plans to monetize any of these parcels?
Sure. We had recently drawn in a real estate management consultant, and they have looked at each of our parcels, and as we speak they have valued it anywhere from 800 to 1000 crores. And so this remains as, I would say, a basket available for the rainy day, and we are looking at options of how to monetize some of them, and that process is underway.
Mr. Sailesh, every growth plan has risk. How do you plan to mitigate these risks?
Yes, I might share that as far as the ammonia and TAN assets goes, since these were on our radar, we could locate these completely unused top class assets where two of the global giants were planning to set up those projects in their countries, and for some reason they had to abandon that projects. We were in a position to negotiate and acquire those complete ready assets at almost 20-25% below cost, and top class, best engineered, best fabricated is already with us. So with that we are seeing a massive risk mitigation emerging from otherwise typically in a project risks emerging out of delays in engineering, delays in procurement. That aspect of it is completely contained. We are also looking at a risk mitigation emerging in terms of cost escalations, because those complete assets are already acquired. Of course, it will also bring in a risk mitigation in terms of the potential time delays that otherwise could have hit a project. Because these are already tied up, we are also looking at mitigating the forex risk, rupee devaluating and all. So that aspect is also contained. But most important is that every single project and every single product that we are looking at, we are not one step away from the last 35 years of experience that we have, whether in terms of raw material sourcing, manufacturing, safety, health, environment, logistics, dealer networks, customer base, regulatory, government policies. Every bit of it is something that is based on the last 35 years of our experience, because we are looking at the same products. We were in TAN, we are going to add the TAN capacity. We were in acids, we are going to add the acid capacity, and similarly. So what this does is also brings in a huge degree of risk mitigation of delivering the IRRs in the smallest gestation period from project completion to smooth operations. The other risk that typically projects face is land. Now, as far as the ammonia project goes, we have already acquired the required land, which is across our current complex. The IPA project, the land is something that we are utilizing from our already available land. There was surplus. And as far as TAN goes, we have a clear MOU signed for the required land. So all this put together, we believe that there are unique risk mitigations that are emerging in our growth plan.
Mr. Mehta, last few quarters have been challenging for Deepak Fertilizers. Can you throw light on top 3 contributing factors that have led to this situation?
Sure. So if we were to look at the last few quarters, it has indeed been a perfect storm. And this aspect of it, as I elaborate, you will see how, and this happens sometimes. We saw ammonia prices going up, but the TAN prices remaining the same, influenced by the imported Afghan prices impacting the delta for TAN. We also saw that because of the crude price hike, our raw material propylene also shot up, but the downstream IPA did not have that reflection, which normally takes a quarter or two as a lag. With the crude prices going up, gas prices went up, and so cost of production went up. In case of fertilizer, what happened was that our key raw material, phosphoric acid, one of the global players and a major supplier to India, they had some environment problems in their complex, which of course now they have sorted out, but the availability was just about 55-60% of our capacity of the fertilizer plant. That certainly impacted us in terms of our production. What also came in were various price increases in the raw material, which we and the fertilizer industry took time to pass on to the farmers. If all this were not enough, rupee weakened quite a bit, and so that aspect also had an impact in terms of the forex impact on all our operations. Having said this, we have seen over the last 22 quarters that some upsets, some ups and downs do come in, and they get corrected over a 1 or 2 quarters. And this is something which we have seen a consistent phenomena where one could then pass on to the end consumer by way of the higher prices. So we have seen that phenomena also kickstart. But having said that, these were the key reasons where we saw the challenges that emerge in the quarters. But these are, I would say, aberrations of a quarter or two, and these are things which are getting corrected as we speak.
Mr. Bhargava, there appeared to be a strain on the working capital front. Has this emerged due to trading? How do you plan to correct the same?
Well, we have two sides of our working capital. One is in the fertilizer business, which is seasonal. So we do have to produce for 6 months before we start liquidating that in the monsoon season. So that builds up the capital and working capital, and to that extent there are peaks and troughs in our working capital. The second aspect of it, which is in our industrial chemical trading business, we started this year pretty much on the background of about 1400 crores of IC trading that we did in last 2 quarters of previous year. In the beginning of the year, we realized that we need correction on the working capital, and so we have constantly started paring down our IC trading business. In the first quarter, of course, we had certain inventory and certain commitments to suppliers. So we, as you would see in the numbers, the first quarter trading was almost 1000 crores, but it's been brought down to nearly 400 crores in second quarter, and in subsequent quarters the run rate for trading would be brought down further. So that has released working capital. What has also strained our working capital in last 2 or 3 quarters was also the fact that in Maharashtra, certain part of Maharashtra, there was drought situation. Therefore, the collection on the fertilizer segment was a bit weak. Also, given that we had not been able to produce because of phosphoric acid shortage, we had taken trading position in bulk fertilizer, and because of port congestions, there was the trading inventory moved a bit slow. But as we speak, that trading inventory we have started liquidating that pretty fast. So this should correct our working capital going forward. The other aspect is that we have the short-term capital market borrowings that we had in the beginning of the year. We have completely repaid those borrowings.
Mr. Mehta, what is your long-term perspective for the fertilizer business?
Sure. So, one aspect that I am seeing is that any large addition of capacities obviously takes a little time to stabilize, and we are expecting this tripling of our capacities, the whole business to stabilize in a matter of a couple of seasons, and so by next year we hope to see an even keel on that. Having said that, we are also parallelly doing massive work in terms of strengthening our systems and processes, and where we have drawn in the best of the consultants to look at moving from SAP to SAP HANA, which has much better decision support systems. We are bringing in what we call as SNOP, the sales and operations planning, So, where there is an end-to-end track from raw material manufacturing, market collection and back the whole cycle, which is IT supported. We are also bringing in very strong focus on the pull and push factors by way of sales optimization. All these are, as we speak, are in various stages of implementation, and these are also going to be showing the very positive, I would say, support to the business in the coming year. The other aspect that we are looking at is in the fertilizer business to move from commodity to almost crop specific specialty, meaning that instead of just selling commodity products like DAP or NPK, we are looking at whether we can position it as crop specific, meant for sugarcane, for cotton, for fruits and vegetables. And this journey is going to take us from customer to consumer, and this is where we see I would say very strong and a positive shift and a transformative shift for the business. This shift is going to be immensely beneficial as India moves to the DBT era, where the subsidies and others will now directly be given to the farmers, and the industry will be more and more like any other commercial industry, which will be moving from government control prices to value based prices, and all our efforts are going to be something which will give us a cutting edge in that phase. Based on the work that we have done, we are also finding that there are very strong interests from global fertilizer players to look at a JV with us, and that is also something that we are seeing as a validation of all the good work that we are doing. So, all put together, going forward, we are finding that the fertilizer sector should be a good sector to work in.
Mr. Mehta, we had heard of the recent search and seizure from the Income Tax Department. What were the areas of investigation? What is the current status on the same?
Sure. So, they came with apprehensions that whether we have somewhere over invoice in terms of our assets, or whether we have claimed depreciation wrongly in some of our commissioning of our projects. And the third concern was the restructuring that we did and the tax structuring that we had done for that. Now, we have given them all the data transparently on all these aspects, and we believe that as far as the first two goes, based on the data, we do hope that they will be taking a prudent view, and on that aspect there were no further questions. As far as the restructuring goes, we shared with them that this was completely in the public domain, because we had taken the whole restructuring for the NCLT permissions, where the income tax authorities were twice approached even at that stage in case they have any objection to it. We have shared with them that we have taken opinions for the tax structuring from Mr. Soli Dastur, from Mr. Bansi Mehta, and there are a lot of other High Court case laws which are supporting this aspect. Having said that, as far as the restructuring goes, there is also a laid out process of conflict resolution between us and the department, and that is something that will be in a natural course that will follow. Having said that, even in that case, there are no benefits in the past that we have taken. These are things that are going to be impacting the refunds in the future. So, we do not see any other negative implications emerging out of that. As a normal process in the search and seizure operations, they are supposed to complete their analysis and close their investigation report in a 60 to 90-day period, and we understand that they are in the process of that closure.
Lastly, would you like to summarize your perspective on the growth plans and the operations?
Sure. So, in summary, I might say that the current scenario that we are seeing over the last few quarters is certainly an aberration, and that aspect of it is getting corrected as we speak, as I have explained, and it is a matter of a quarter, and these aspects should pass over. As far as the growth plans goes, we are very confident on the robust IRRs, We are confident that the products that we are into are very strongly aligned to the country's growth story. On our side, they are very well aligned with our 35 years of experience of doing these projects as well as the products that we are into. And lastly, that we are looking at the most cost effective project outlay, as I have explained. So on both fronts, we are looking at life ahead in a very positive light.
Thank you, Mr. Mehta and Mr. Bhargava, for your time and providing your perspective on the common concerns of the stakeholders.
Thank you.
DFPCL. Grow for India. Grow with India.